So we don't have a death tax in Australia, but there are tax implications when you die. The two most important CGT consequences that are going to affect you here is you're going to inherit both the cost base and the date of acquisition. So when you inherit the cost base, you need to keep documentation of what the deceased paid for that asset so you can claim it in the cost base calculations when you finally do sell the asset. The time of acquisition, this is what I think you're really asking. It is still the date that the deceased purchased the asset. It doesn't reset to when you receive it. And that's because there's special rules that ignore death as a CGT event. So everything basically just moves to the beneficiaries as if they were standing in the shoes of the deceased. If the deceased lived in the property and then passed away, you can still claim the main residence exemption in some cases, but you need to sell it within a specific period of time, which I think is 3 years, but I might be wrong on that. It's often good for the beneficiaries to get tax advice from their accountant when someone passes away and they receive assets because it can get really complicated. This is just general stuff.